Hello everyone, welcome to today's webinar, Practitioners Insight, Artificial Intelligence, AI in Investing. This is hosted by the CFA Society India. I'm Meera Siva, I'm an independent consultant and co-founder of Rana Investment Advisors. We work with early stage startups and I'll be the moderator for today's webinar. Now with an online format, that we have been following, it's not as rich as an in-person interaction, but the benefit is we get to hear from global speakers and partake in their knowledge. And we also want to welcome our audience who are joining from around the world. It's always quite exciting. Before we get started, just a few housekeeping points for everyone's benefit. The webinar will be 1 hour. And it's kind of split equally between presentation and question and answer. So there'll be enough time for that. Please submit your questions anytime during the session by clicking the Q&A button at the bottom of the screen and typing your question. And you can access the slides once the presentation concludes. It will be available in the chat box. We always value your feedback. It helps us improve the sessions we do and the format and a whole lot of things. So please complete the evaluation survey before you log off today. And we also do have 2 polls to better understand the audience and the needs. So please do participate and give your inputs. So that done, it's my pleasure to introduce our speaker for today's webinar, Rani Piputri. Rani has an awesome profile, and I will only touch upon a few key aspects of her bio. She is currently the head of automated intelligence investing at NN Investment Partners, managing Euro 7 billion AUM. She was also a board member of the CFA Society Netherlands for 4 years, and she is currently in the annual conference advisory group of the CFA Institute. Her degree is also very interesting. I found it very exciting to see that. She has a master's in Financial Econometrics, so awesome. And that's from the Erasmus University in Rotterdam. It's great to have you here today, Rani. Over to you.
Thank you, Meera, for the introduction. Good afternoon, everyone. I'm happy to have you all in this webinar. In the next 60 minutes, I hope I will be able to share with you some insights that I gained during this 20 years of me as a practitioner in the fields. And yeah, it's been 20 years and it's counting. Before we start, it's probably good just to get to know each other for all of us here. So we will do that through a poll. To see how familiar you are with the topic that we're going to have today. So, Meera, we could probably just show the poll right now.
Yes. Yeah, so we'll probably give some 20 seconds for people to fill in the choice on, their background in AI and their knowledge. That will help Rani to tune the presentation and the pace accordingly. So we'll leave it on for a few seconds more. Okay. Yes. Okay, so interesting. So we have very few in the bottom segment of using AI. More are in the middle segment of having some knowledge but not using it every day.
Yeah, this is actually quite a nice distribution of people who are interested in AI and starting using it, and some of us apparently has used it for quite a bit. So it's good, and I try to cover my presentation to cater all of your needs. Do ask your questions in the meantime, and Meera will organize those questions. Okay, so let me start by sharing you my screen. Let's see. There you go. AI investing. Let's start from the very beginning. What is AI? Artificial intelligence. That word has been floated around a lot in the media, among professionals, and among peers. And AI itself actually on the core has a meaning that is quite broad. AI is intelligence that is exhibited by machine or software, as opposed to intelligence that is exhibited by life forms such as humans or animals. So we usually refer to AI when it comes to systems or machines that can show some cognitive ability that we often associate with the mind, such as learning and problem solving. Also within our industry investing, or if you read the newspaper, the word AI and ML, which is a short of machine learning, are often used interchangeably, but they're actually not exactly the same. As you can see here in the topology, artificial intelligence comprises more than just machine learning. Within AI, we have an area of robotic that is growing pretty fast actually, and it's actually been around for some time. We have expert systems, which at its core is a database of the knowledge of human experts that are being compiled and processed to be used by the user to make better decision. We've got NLP, natural language processing, that is actually growing towards natural language understanding. So not only we have machine that can process the words or textual data that we have, but we also have development where we are teaching the machine to start understanding what the textual data means. So an example of this would be sentiment analysis that is extracted from the media or from article. This done by machine that is built to be able to recognize whether it's a positive sentiment or negative sentiment. And we also have the human-machine interface, and this refers to the sensors that we use, for example, on the highways or in the shops to measure foot traffic. These are intelligence that are operated by machines, which used to be done by humans many generations before. So machine learning itself is an area that is very relevant within investing. And as part of machine learning, there's also deep learning. It is another specific topic within machine learning that is being used more and more within finance. And several firms have shown some interesting results, but this has not been mainstream yet. So there is still a lot of development and potential that we will see in this area. So AI and automation they have a very close relationship. We can see the interaction between AI and automation in two dimensions. One dimension is on the system itself, how specific versus how adaptive the system be. And the other dimension is whether or not the human is in the loop. So in the category where the system is built to answer specific question and human is still in the loop, we are talking about assisted intelligence. This is where we use data and analytics to drive business insights within the existing process of decision making. So you'll see this in businesses where we look at the data that the company has and start making good projection about its sales. Or in investments, for example, in my firm, we use this in looking into several risk metrics, and we use the stoplight system to give a signal whether a situation is red, yellow, or green, depending on the severity of the risk measure. And at the end, the human is in the loop because we as human will still decide what to do with that information. So in the area of adaptive system, this is actually more prolific than we think. An example there, as you can see, is a Google Map. This is where augmented intelligence is taking place. This is where new ways for computers and humans collaborate to make better decisions and taking more effective actions in continually changing environment. So in a Google Maps, you want to go from A to B, and Google will give you a recommendation of route that you can take depending on the means of transport that you want to do. Either you're going to walk or by cars. When you're going to drive, it will tell you almost real-time information where the traffic jam is, so that it can adapt to the new situation and give you a better recommendation for that time. At the end, again, we human as the user decide what to do with that information. So this is where human is still in the loop. In the area where human is pretty much minimized in its influence is in automation itself. So this is where business processes that previously performed by humans are now replaced by machines. We see this a lot in industrial companies, the machineries that are being used to create products. We also see in service industry, like our industry in investment. The most simple example is in report generation. You know, I believe most companies now, when they generate reports that has to be published every month or every quarter, this is done by a certain level of automation where humans are not the ones doing or creating the reports anymore. It is being scheduled to be published in a certain time. And at the end, autonomous intelligence is where the system is adaptive to be able to respond to the existing situation where a human is not in the loop anymore. And an example here is the self-driving car, although we are still quite far from the reality of this being a widely used part of our lives. The self-driving car is where the systems are adaptive and it can autonomously carry out tasks without human intervention. We still have, in some countries now, we have the self-driving cars with still a driver in the driving seat. In the future, we can imagine a situation where the human is not necessary anymore. So that is the basic of AI, what we have at the moment. And then the question can arise, okay, AI seems to be a very interesting, very hot topic. How about AI in investing, and why are we talking about it now? Well, in reality, some of you may also experience that AI, if we refer to the definition of AI is, as I mentioned before, AI has been around for quite a while. The type of systematic investing that was done in the 70s, it is also based on the understanding of AI. But now we see that this niche area become more and more mainstream. And this is driven by three factors. One is big data, and secondly is the availability of tools that are advanced, and third is the fact that the investment landscape where we operate becomes increasingly complex. I will turn into each one of this topic in the following slide. So big data. This is also something that has been mentioned a lot. I believe the most of you have encountered this big data, and again, we can actually think what is big data really? You know, in this chart, I would like to illustrate how big data actually differ from small data. You know, in the past, we work on individual cases that are very dependent on the context, and we look at things in a very limited context. And if we look at the data in the dimension of homogeneity of the data and the temporal scale of the data, is it information that we have at the moment, or is it a longitudinal data that goes through time? And the more we have data, now we start seeing patterns that are common. We see certain trends that are outside of that specific case that we used to look at. And this is supported by the fact that it becomes cheaper and faster to record and to store, process, and to retrieve those data. The technology advancement make processor even smaller, so this is now becomes available to us. Data that used to be very difficult to record and to process, now it is there. And this flood of data is generated by humans as well as machines. So humans, you know, we use social media to tweet, to write blogs, to repost videos like this one. This is all information, this is all data that now can be used for a lot of uses. And machines itself, with the sensors that I mentioned before, also generates a lot of data, a lot of information. And this data tend to be rather unstructured. In investment, we were used to work with structured data. So, for example, an equity investors would look at information of companies, and we can look at their prices, we can look at their dividends. They have the same form and the same structure that makes it easy for us to compare. But now we also have information such as textual data that comes through article in social media. These are not structured because they can have different length, they can have a different usage of words, even the letters that are being used. We are in the Western world. We use alphabets, but a big proportion of the world population use different kind of characters. So this unstructured data actually adds richness to the structured data. And we also talk about traditional versus alternative data. This is also one thing that has been, that has gathered a lot of attention in the past years. I remember about 3 years ago, this is where we see a lot of new alternative data provider shows up. There are conferences about alternative data, and it was not a fad because alternative data is the new sources that we have now. And if you think about it, how is alternative data different from traditional data? And this is also very context dependent. I used to work in a hedge fund that invests in equities. And then I moved to another hedge funds that actually work with time series data. So it's more a CTA, so trend following hedge funds. And in the trend following worlds, the only data that are being used are prices data of different instruments. And this means that the data that they use are just prices data, either is a long-term or is it tick data, but that's only what they look at. And then the concept of dividend, for example, which is a very standard data and can be considered as traditional for equity investors, is actually seen as an alternative data for investors who never use it, or they use it in outside the realm of equities. So this is where the definition of alternative data can get a bit confusing. But in general, we see traditional data are data that are provided by the company itself through its financial releases, or data that are provided by the governments. And traditionally, this information is lagged. You usually get the data a month, 2 months, 3 months after the actual event, and not always easy to access. And alternative data is data that comes from unusual sources, such as web tracking, blogs or tweets, or different kind of sensors. And as you can see here, there are many different categories for alternative data, and this can be quite overwhelming. In this ocean of data, you're an investor, where should you look at? You know, and that's why this is also for me to make a point that domain expertise and human knowledge, the contextual thinking is very important. So I am going to talk later about how is the interaction between the man and the machine. But this is one example where human knowledge and expertise is still very much required in actually acquiring data and pick the context that are relevant for investment. Another area in terms of big data is Internet of Things, IoT. This is the extension of internet connectivity into physical devices of everyday objects. Soon, if not already now, in some parts of the world, that we have our refrigerators talking to our radio, talking to our lighting system in the house, records all kinds of things. They talk to each other, and this generates, again, a humongous amount of data, as I mentioned earlier. Financial Times reported this is actually a chart from already a year ago. It shows that within 10 years of time, the data that is generated by internet actually more than 40 times larger than it was before. And this Internet of Things have a very close relationship with AI, with the artificial intelligence techniques that we talked about before, because IoT generates a lot of data, and data is the food or what we fed into AI. This data makes AI better because the more data you have, the more accurate the prediction that AI can make. At the same time, all this data without AI will be pretty much useless because human beings cannot process this amount of data. This is simply a task that I don't think anybody would wait to do. So this interaction is actually very synergistic and work well together. Another area that propel the AI techniques to become a more mainstream approach is the fact that open source codes and free programming language become more and more available. You know, this is a list also created some time ago that the popularity of open source codes are increasing. You know, nowadays Python becomes also a well-known programming language. People don't ask anymore what is Python. It's pretty much the question is, does CFA teach you to write in Python? So we see that this actually helped democratize the concept of AI because this programming language is free and open and everyone can learn, everyone can collaborate with others all over the world how to use it. And because it is based on collaborative system, there are continuously improvements in the quality. And not only in the open source programming language, we also have systems, analytics providers within investments. This screenshot, some of you probably are very familiar with. These are the standard things that investors would use. They may look alike, but they actually come from 3 different providers. These are from Bloomberg, Refinitiv, and FactSet. 20 years ago, when I started my career here, they look quite different and they have different expertise or they have different strength. One is good in portfolio management, the other one is good in real-time pricing data, and the other one's good in performance attribution, for example. But now we see that they also develop, they grow to improve their visualization, they become more flexible for the users, they're faster and intuitive. These are tools that also use certain form of AI, and this helps us to make better analytics and forecasting. So with that, I actually would want to take, I would like to take a pause and see if there's already some questions.
Okay. There was a question which I think you'll be covering later, but I do have a question based on what you were covering on, you know, you talked about structured and unstructured data, and there is, you know, this whole aspect of sentiment analysis with natural language processing, and, you know, people claim that they can derive some alpha based on, you know, what's trending in Twitter and the sentiment of the market. What are your views on, you know, how well it is developed and how it is used by the more mainstream investment community?
That is a very interesting question, Mira, because this question is also quite close to my heart because in the firm that I work for, we work quite extensively with this kind of sentiment data. As you know, sentiment data itself, sentiment index has been around for a while, but we are getting better and better in making more accurate sentiment prediction. And sentiment itself is very adaptive. It's changing. Certain themes that were considered good may not be good in different contexts. As an example, if there is an article talking about a war, this will give a negative sentiment if you look at it in terms of macro stability or economic stability. But if you look at companies, you look at defense companies, companies that actually sell tanks or certain weapons, this is actually a good sentiment indicator. So that's what makes this sentiment data very ambiguous to work with, which means a great opportunity for people who actually put the work into it. So my own experience with sentiment data is actually not buying the instant sentiment information that are usually being provided by a data provider, where they sell you sentiment positive, neutral, or negative, but we actually would like to go a level deeper to know what are the components that they use to calculate the sentiment data. So yeah, it is actually a very rich area, and also there are some data providers providing this kind of information, but I think it's very important for us as the user to understand what is it really that we're looking for. So yeah.
Okay, allied to that, there's one question from Rajiv Agarwal on, what structured and unstructured data is being used and how is it correlating best with success in investing, right? So, what have you seen to be the kind of structured and unstructured data that has worked well?
Yeah, so relating to what you mentioned earlier about sentiment data, the fact that the data is unstructured, that means there is an alpha opportunity there. It's very much depend on the kind of work that we want to put into it. Structured data is easy to work with because it's structured, but if it's easy for us to work with, that means that everybody else can also work with it very easily. So even the people who know very little about the algorithm or know very little about the ingredients, they can use the data just like you use the data. And then, if the alpha source is publicly available, if too available, then it's gone. So the fact that certain data is unstructured, there is actually a very fertile ground for us, an investor, to delve into it and to be able to extract information that most people either unable or do not have the infrastructure or do not have the understanding to structure it to get the potential alpha in it.
Okay, so, again, this unstructured data seems to be of interest to everyone. So allied to this, the question is unstructured data applicable to, all kinds of company investments, or would we apply it selectively to certain sectors or certain, groups of companies alone, right? How would we pick the usefulness of certain data to the kind of the investment?
This is an interesting point that actually we will go back into later, that the context is very important. What I notice in my experience is that having certain unstructured data to apply to everything, that at least that doesn't exist, or at least I haven't seen it. So it has to always be applied within a certain context. So a very simple example, the sentiment data again, this kind of data that we get from textual data articles that give the sentiment of the authors or the writers or the public about certain topics. It may relate to only specific area. So we know the basic of equity and bonds. Usually when equity people are happy, the bond people are not happy, and the other way around. So the same data, if you apply it everywhere, you may get the unintended results. So it's always important to use it within the context, usually quite small context, that you look for answer.
Okay. So, there are some more questions, we can move on and, pick up further questions as we go along. Yeah.
Great. Okay, so now I'm going to look deeper into the kind of tools and techniques that AI has made possible specifically for investing. And there are three areas where AI gives a real advantage for investors, and that is in search and optimization, in classifier and statistical learning, and probabilistic method. So on optimization, most of you who manage portfolio, you will know that our goal is to find to construct a portfolio that has some optimality in it. And typically we look at risk and return relationship. We typically look at this efficient frontier, as you see in the first chart here, using mean variance optimization to find the point where expected return is commensurate with the risk that we're taking. But this is only one dimension. We can look at the other dimension, which is the time dimension, where we can see whether the efficient frontier that we found on specific point in time, whether it's actually robust through time. You can imagine when we pick an efficient frontier consisting, let's say, 50% bond, 50% equities. In 1 year, it looked optimal, but if the next year the optimization shows a very different result, then you still have to deal with high transaction costs, and this is not stable. And over a long term, we would like to find a stable area where the efficient frontier on any point in time may not look like the best in that particular point in time, but over a longer period will be a better solution, taking into account the changes in transaction costs date from one period to the other. And this robust, this stable region of portfolio construction also will help us to evaluate the portfolio. It helps us understand how the portfolio might behave in different situations. So this is one of the easiest example how optimization, how AI actually being used, because AI is, there is a lot of artificial intelligence used in optimization, and optimization is just part of our portfolio construction approach. Another area is classification and statistical learning. And this may look rather trivial, that we're looking into how to classify certain stocks, but it is actually less straightforward than it looks. In this chart, I show you 10 large US companies, from Apple to ExxonMobil. And in the vertical line, there are 3 different ways of categorizing these companies. So the middle one is categorization based on gigs, which is developed and commercialized by MSCI. And the other 2 is according to the NLP and covariance. So in covariance methodology, basically it looks at the price behavior of these companies. You just calculate the correlations or the covariance metrics of this company compared to other ones in the investment universe. And here you can see, for example, that companies like Johnson & Johnson, although it is categorized as healthcare according to the standard classification system, it has a very different behavior and dynamic in terms of its prices or in terms of its returns. And it actually sits closer to Apple. So covariance matrix it only looks at this information, whether it makes sense or not. I leave that outside of the scope of this presentation. And another methodology that uses AI is NLP, natural language processing, where the classification of the company is based on the annual results or annual financial numbers that the company published. So it's basically, it looks at how the company describes itself. So a company, again, like Johnson & Johnson, who is either healthcare or IT, but the way it describes itself in its annual results reflect more similarity with pharma or biotech, which is a sub part of healthcare. And in the NLP, there is also a dynamic part into it. We can see that certain companies change in terms of how it evolves in the area where it operates, such as Amazon. Amazon used to describe itself more as an online service company, but now it becomes more and more a retail company. So this is an example of how AI can be used to classify stocks, and how is this relevant for us as investors? Again, this creates an opportunity. We still see a lot of strategic asset allocation or maybe tactical asset allocation where investors invest in certain sector. And this is reflected also by ETF, sector ETF that we see being traded in the market. When the economy is not doing well, there's a risk of sentiment in the market. People will invest in more defensive sectors, pharmaceuticals or consumer staples, and investors tend to just invest as a whole into that sector, not looking into the fact that there might be some companies within that sectors that actually behave quite differently than the sector itself. So this is where arbitrage opportunity can exist. So Amazon can be also a great example there. And then the last topic on AI-based tool that I would like to cover today is on the probabilistic methods. This is a slightly different approach for us as investors to look at investment opportunity. Typically in equity investment, we look at a company and there is a target price, what analysts would expect the price to be within 12 months. Now this kind of point estimates becomes less and less common, and we see that analysts more and more look into the probability of this actually happening. So instead of saying that a certain company will reach a price of 100 by the end of the year, they will look at the probability of a stock going to a certain level, either up or down. And within AI methods, as you know, AI methods is very good in the ability to discover relationship that is not very apparent. So in this example, if you want to know the probability of a stock going up by the end of the year, the input data is actually can be quite broad. It's not only the intrinsic data of the company itself, such as price to earnings or dividend yield, but it is also influenced by the economic conditions. So with GDP forecast or market indicator, and this kind of data, this kind of input can work in a relationship that is less obvious. So you know that within AI techniques, we can go from very simple regression model, simple regression that we've used for a long time. It is actually a form of AI. We can use a neural network with one layer, which is considered simple, and we can use an even more complex where there are multiple layers. Here, the relationship between the input and the ultimate output, which is the probability, becomes quite diffuse. So with AI, we have the situation that probability becomes more accurate, but explainability becomes more difficult. And although the probability that is generated by AI can be quite accurate, we still have the controversies in real life, where, especially when we talk to our clients, because our counterparts or clients or whoever we talk to would like to understand, how do you come from a PE, for example, or dividend yield, GDP forecast, how do you come into this probability? And there comes the difficulty, because we tend to think about causal relationship that is linear, that one cause B and B cause C and so on and so forth. And in economy, in investment, it is actually a bit more complicated than that. So you can imagine an analogy situation. If you ask a 5-year-old child, you show them a picture of a cat and a dog, that child will most likely be able to say which one is a cat, which one is a dog. But if you ask that child, okay, explain to me, why do you say that one is a cat? That is actually a very difficult question, because just from the look of it, it has 2 eyes, it has a tail, it has 4 legs, but somehow you perceive it, you see and you know there is a cat. So that's where we are as well with machine learning for investing. Sometimes we get an output that proves to be good, but it is very hard to explain. And a lot of people are still very uncomfortable with this fact, even including regulators. So although this is also an area where there is still a lot of potential that can be harvested, machine learning is not a monopoly of investing. Obviously, we can generate or we can use algorithms that are used in disciplines outside finance or economic. So for example, the evolutionary biology, the algorithm that is being used there can be used for us to train or to test different trading strategies to see how they compete with each other and which one would win, you know. And that is also the situation that you know, that is quite realistic for us, with different kind of styles competing in popularity, such as value versus growth or other kind of strategies. And also thermodynamics, it helps us understand the order and the disorder of economic systems. So yeah, AI is really multidisciplinary, and it's good for us to, you know, expand the horizon. And again, I would like to stress the increasing complexity in investing, which is the reality. You know, we learn more and more that markets are not always efficient, and the market participants are not always rational. So the connection between different factors or aspects in investing becomes more intricate. And the fact that the markets keeps changing, you know, market structures change from time to time because there are new players in the market, or certain players becomes more dominant than others, you know, such as the proliferation of passive investing right now. These are some dynamic in the markets that can be learned or predicted using AI. And AI is specifically good in this because it can help us understand relationships that are not linear. And you know, the fact that we are dealing with multiple players, so it's not just two-dimensional of company and investors or company and prices, but there are different aspects. So before I move to the next part of my presentation today about how really, how can we transform ourselves as profession and our industry from what we are or we were before into the future investment management company that can benefit from AI, I would also give the chance for other questions if there are any.
Yes, we have lots of questions. I'll ask a select few. So we have a question from Vidhu Shekhar on, you know, you spoke of probabilistic models and, you know, lots of different tools to use. So his question is, you know, is game theory used in AI, right, particularly in the investment context?
Yes, game theory is also a topic that is relevant. In my particular experience, we are looking at more in an agent-based modeling. So that can be seen as an overlap as well with the game theory, where we can see how a certain behavior or certain actions of other market participant affects share price. An example here, you probably also know that we typically look at the financial data of a company to say whether the company is a good buy or not, whether the price is good based on the numbers that the company produces. But we've seen in the past few years that some companies are kept being bought by investors regardless of their valuations or their fundamentals. So this means that that the price is actually moved not only by fundamental information of the company itself, but it's moved by other participants. You can put it simply that these are just growth investors keep buying, but we cannot ignore that, because at the end of the day, if we see a driver in the market that drives a price, that drives the price of a company that we want to buy, then that is on its own a very valuable information. So yeah, game theory is very relevant here, especially also in the area of, like I mentioned before, the active and passive investing, because we can build a model with certain probability how this would play out, for example, and that help us position, either we are passive or active investors, to be able to benefit with what is most likely to happen.
Okay, and there's one question from Rajani Dameja on the tools, right? You know, are there more ready-made tools from the likes of Bloomberg, and there was also another question on what are the packages and others that you use, right? So that people can get started with something rather than starting from scratch, everything coding.
Yeah, so in my experience, usually once you learn one programming language or one type of language, regardless what it is, it makes it easier for you to learn other languages, because basically it's just the logic that you learn. And you know, when in my career, I've been using MATLAB a lot. I learned it from scratch, but now I'm learning Python also from scratch. And it is almost inevitable to have to learn something from scratch, because there are also the ready-made tools, such as, you know, Bloomberg, for example, that gives you a lot of tools to be able to get insights. And they will work for 80% of the cases. But as soon as you want to have something that is rather specific to your own situation, then some form of intervention from yourself that will require some programming will be required. So, so yeah, it really depends where you are and where you want to be. Usually with ready-made solution, even optimization, you can use optimization tool out there that are available. You can already get a lot of insights from there, but as soon as you want to do something that is not mainstream, a bit different, and there where you might have alpha, then certain, yes, customization is required, and that means that you need to be at least comfortable with the code itself. And yeah, based on what I gather so far, is Python seems to be very friendly in being used, and a lot of people also in my team, they learn Python also learning by doing. You know, I don't think there is any school that is actually teaching Python, but so people can actually just learn themselves.
Okay, there are, you know, even more questions, but, you know, since we are 15 minutes from 6:30, you know, let's get through the last part of the presentation and take up further questions after that.
Okay, great. Yeah, so how can we move to an environment where our industry and our profession actually benefits from AI? This is, yeah, I'm afraid we will have to start from scratch, look at the basic, because again, AI is built on data. So the data culture should exist in the company that we operate. Even a very good algorithm will not work if the data is wrong. And also the understanding that data is not the same as reality. We try to make the best representation of reality using the data that we have. And I often make an analogy of this with an oil refinement company, because data itself is oil, but you cannot pour oil into your car. You need to pour gasoline. So the oil needs to be refined and processed to make it fuel. And this means as a firm, we need to have disciplined teams that works in a setting that is explorative. And this means that we have to go doing some experiments that we do not know yet how it will come out. You know, in our industry, there is how do you call it? We really want to have control. We really need to understand everything from the start to the end before we even started. So this requires a different mindset when we want to apply AI in our industry, because otherwise a lot of data, a lot of effort will not give you much in return. Of course, there are a lot of challenges. What we've seen in many business is in terms of data acquisition and analytics. So a big company usually have a lot of data that the company itself generates, but they are not accessible across different systems. They don't talk to each other, and the quality might be poor. And in the data analytics, we still need people who actually understand the data and to be able to develop effective models. And in terms of value chain, we also see that the data and the models and the actual user, they can be quite separated, which makes alpha leakage a very important, can make this leakage a very serious situation. In some companies, I see that the data teams are separated from the developers that actually that actually build the algorithm and process the data. And you have the investment team, the portfolio managers that use the data without really knowing what is really the ingredients that goes into the algorithm and what does the algorithm do. So this disconnect is far from efficient. So if we want to build an industry or profession where we can deal with this explosion of big data, as we see that as time progresses, we see that the data volume keep increasing, we need to close the knowledge gap and the execution gap. The knowledge gap is, again, is the difference between collecting the data and actually understanding it. And the execution gap is the difference between understanding the data and being able to act on it. And these are where we as humans actually play an important role, because knowledge gap is to be filled by us as well as the execution gap. And different companies have a different level of development in terms of the data-driven thinking and AI usage in their processes, in their approach. It goes from a descriptive level where they use data just to show how processes happen today and in the past. They can move to the next level into the analytic, where the data and models show how and why processes happen as they do. And the next level will be making predictions. These data and models show how processes will happen in the future. And the last bit, the more intelligence the system, it will also become prescriptive and give recommendation for actions. And this is again the synergy of man and machine that I mentioned earlier. Although some of us, I get questions regularly about, the possibility that we all will be replaced by machines, and I don't think we are there yet, and it may take a long time to get there. As it is now within investment industry, we have a situation where the data is quite dense and the problems need to be solved is very easy. Then we should let the computer take over, because that's what it's supposed to do. It helps us to deal with familiar problems fast and less error prone. Whereas situations that is highly unique, one-off events or crisis, this is where humans are still superior in dealing with the situation and making the best prediction, especially when the data density is quite low. And there is a virtuous cycle between man and machine. As we know, machines or computers can process more and more data and can do it very quickly. And this gives us better insight and more timely insight. And this helps us to execute on those insights, and technology makes it possible that this insight can be executed quickly and we get the feedback also in a timely manner. And this again will enrich our knowledge to improve the data and the machinery that help us, so it goes and on improving the step each time. So concluding remarks on this part is that big data and AI are here to stay within investments. They are means for evolution and not revolutions for us. We see that these developments in AI and big data, they become part of our lives slowly and in a smoothly manner. Is barely disruptive, but it will change how we invest, how we look at the world. It will bring big changes in a way that is fluid with our processes. And what does it mean for investment professionals? How can we be future-proof? My points is, or my message has always been, take the driving seat as humans, because the machines, the data, the AI, they are there to help us. We still need to understand them to be able to take driving seat. That means we need to increase our numerical literacy, and we need to invest in technological skills and tools. And most importantly, that we need to keep the big picture and the problem very clearly. You know, AI can only help you solve the problems if you know how to identify the problem and formulate it in a solvable form. And this is something still that we are much better equipped to do it than machines. So that would be my the last slide of my presentation. And I think we still have some time for concluding questions.
Yes. So do we want to run the other poll?
Yeah. Let's do the second poll.
Okay. So while we wait for the poll, and I request you all, it's a pretty simple question on your views on where we think, you know, AI will be mainstream in your particular case. I'll ask the same question to you, right? So where do you see in the short term and in the more 5-year kind of time frame would people be replaced more and more by machines? What do you see? And if that's what you see, what may be the enablers for that, right? You know, because there could be a lot of missteps along the way, and how does organizations prevent those?
Yeah, I think there will be some areas where people will be replaced by a machine. We've seen in the operations, for example, people who used to have to produce reports, that now becomes more and more automated. So there will be less people doing that. And that actually coincides also with people who would like to develop themselves. At least in my experience, people who work in producing reports, at some point they will say, I'm not going to spend the rest of my life producing reports. I would like to learn something new. I would like to grow. And this is really the opportunity, because now they can leave this kind of activities to machine, and they can start growing their other value added. And again, this will become a slow, this will become a gradual process. So we will not see suddenly that half of the workforce will be replaced by machine, but we start seeing that people becomes more and more polarized towards a high value added work. Yeah, I hope that answered your questions.
Yes. Yeah. So we have the results of the poll. I hope you are also able to see that.
Yes.
It's kind of the opposite of what we saw with the first poll, right?
Yeah.
It's
I think it's very interesting that some of us also think that AI will never become a mainstream, and you know, I'm not a prophet, so I cannot say how it's going to look like. But what we learned in the past with regard to AI outside of investing is that it can encroach into our lives without us understanding it. So an example that I mentioned to some people before was our smartphone, right? Our smartphone is full of AI. It's all AI. It knows, you know, it can give you a recommendation where you want to go. It gives you a reminder if you have an appointment. And it just happens so gradually and becomes such a part of our lives that we don't think of it as AI, but it is all artificial intelligence. So yeah, and nowadays, if you ask people, most people have a mobile phone, a smartphone. So yeah, it can become a mainstream without us realizing it. So
yeah. Okay. So there are a few questions on how to get started, right? That, you know, are there, there's also the feedback poll for, you know, people to fill in, because it's very important for us to get your feedback. And we will be sharing I think it's already shared, the presentation. And members can claim professional learning credit, you know, so some housekeeping out of the way. So there's a feedback, you know, available for people to fill in. Now, you know, the question was on what may be some books or some resources, and, you know, where it's more a case study kind of thing, where people can learn practically how to get started and how it's making an impact in investing.
Yeah, so the basics, I can share some of the experience of myself and my peers. For example, we learn the basic knowledge through one of these open source education like Coursera or Udemy, where when you can learn the basic of Python, for example, or you learn about what is machine learning, what is, or even what is linear regression, how do I deal with a certain situation with complex inputs, which a lot of it is actually, I think, also covered with CFA curriculum. If I'm not mistaken, CFA is also revising its curriculum to include more of this big data and AI knowledge. And there are also some textbook. I actually was also in a webinar on portfolio construction using machine learning with Marcos Lopez del Prado, who it happens to be on my desk. I cannot show it here. It's a book, it's a textbook about financial machine learning. So now there are textbooks that cover AI or machine learning specifically for investing. And these books will give you also examples, and it gives you the software and it gives you the data so you can actually practice doing that. And yeah, I would suggest just play with it, because you learn more by doing it.
Okay. There was also a question on, while we look at generating alpha and, beating, will this probably end up the way of where algo trading is, right? That, it just is whoever has the fastest machine or a resource, but just not much alpha getting generated. Do you see that risk?
Yeah, the risk is how do you call it, is there. So it's definitely not there. It's definitely cannot be neglected. But the algorithm is also built by people, by humans, and by understanding how they are being built, and we can understand them if we also build them. We can actually learn the weaknesses or the strength in there. Algo trading came into prominence about 10 years ago. It is part of our ecosystem now. It is still there, but it doesn't wipe out the non-algo trading, the people who still invest in old traditional way. So, and we should also not forget that there are also parallel with this movement of AI, there is this sustainable and impact investing, where people invest in the long term. They will not get distracted by, the quick algorithm, the short-term movements of the prices, because they really invest for different kind of impact, for different kind of return. There's not only financial return. So this brings richness in our ecosystem, where different players can still get their goal without sacrificing others, because they have a different time horizon or they have a different purpose.
Okay. Can you please repeat the name of the book? There are multiple requests to...
Oh, it is written by Marcos Lopez del Prado. Let me see if I actually can show it to you. Oh, there you go.
Advances in Financial Machine Learning.
Yeah,
okay.
This is at least the ones that I've been using as the base, the textbook that I use. I can put it on the chat. These are the author.
Okay. And there was also, some questions on, while we look at generating alpha, what about the negative, the downside risks, right? Where there are cases where there were huge mistakes, or the algorithm prevented one from making huge mistakes, right? Not just the outside, but something on the downside aspect of these algorithms.
Yeah, so algorithm can have unintended output, and that can be a simple mistake by mistakenly changing the comma with the dots in a different kind of setup. And it can also be something that is entirely more fundamental, so that the algorithm give you a certain prediction that is actually doesn't really pick up what you want it to pick up. So that's why this kind of domain expertise is still very important. So I believe the majority of our audience are CFA, either studying for CFA or a charter holder. You get that domain expertise. You understand what is important in investments. So it's always good to also look at it using that kind of common sense. So forget the algorithm for a bit, you actually look back, what is it really that I want to solve? What is it really that I expect to see? And when you see something that is different, it doesn't mean right away that your model is wrong or your hypothesis was wrong. It's always good to understand, why does it give me that result that it gave me? And that's the analytical work that is very valuable, and that is the superiority of us as humans in this case. It's always recommendable to have more than one team actually looking at the code, because you have someone else to be able to look at it with fresh pair of eyes to see whether it makes sense, whether there is no unintended stuff in it.
Okay, probably one last question is, we try to talk examples more from the equity point of view. Are there also applications you see already in use in the debt side and the derivative side and other assets?
Yes, so as you know, in the fixed income side, the data is probably less, how do you call it? You have to deal with many different kind of data, which is different from equities. So we use AI technique to, for example, to be able to read documents and change it into an electronic version. It's called optical character recognition, because this also helps us understand the prospectus, understanding the forms that are often being used in a more like debt or loan investing. So the AI techniques are mostly used to fill in the gaps in the data itself. So there are also different kind of machine learning techniques to be able to detect outliers and to be able to give a recommendation what missing value should be. So it's probably a bit more technical topic for now, but we use that kind of AI technique to deal with the data to make sure that its integrity is warranted, even though we get the data in a very raw form, sometimes unstructured, missing data. We use AI actually to be able to fill in those gaps quickly, instead of having a person having to check the prospectus or having to check all the reports one by one. We actually use AI to give us a recommendation with the highest probability of correctness.
Okay. Okay, so there are, even more unanswered questions, but, in the interest of time, we are 10 minutes over. Thank you so much, Rani. It was quite, interactive and enlightening, and, lots of promise and, lots of things for investment professionals to think about, especially the young ones, to understand more and be on this field. Thank you everyone for participating in today's webinar. If you haven't filled the evaluation survey, please do. And thank you again for joining us today. Goodbye.
Thank you, Mira. Thank you, everyone. Bye.
Bye.